Hey guys, this is your host Nitin Binhani, and a very warm welcome to my startup podcast channel Jazair Audio, where we share real stories with real learnings.
In today's episode, we're diving into the story of Plus Gold, a startup that turned heads on Shark Tank India, raised over $1.2 million, gained thousands of users, and still, just a year later, shut down. If you're thinking, wasn't digital gold supposed to be the hot thing? Well, you're right. On paper, the concept was shiny, yet just like Gold Pay, Plus Gold too shut down in a year. So, what went wrong? Let's cover the story into 3 parts, followed by the lessons for the founders. Part 1. The Rise. Founded in 2022 by Veer Mishra and Raj Parekh, Plus Gold positioned itself as a full-stack digital gold savings platform that let users invest small amounts or set up SIPs, all designed to make gold investment as easy as ordering grocery on your phone. The target were young Indians who wanted the benefits of gold without worrying about purity, storage, or making a trip to the jeweler. In India, gold has always held a special place in heart, both as an emotional asset and as a safety net. People love the idea of flexible gold investments. The trust factor was built in. Indians already love gold, so the barrier to adoption was low. The exposure from Shark Tank India was a PR jackpot. After Shark Tank, Plus Gold's user base grew quickly. Investors quickly took notice. The founder of ACO Insurance, Varun Dua, along with others backed Plus Gold. With over $1.2 million funding secured, Plus Gold looked like a safe bet for a new age fintech boom. However, as they say in the startup ecosystem, shiny doesn't always mean sustainable. Part 2. The Hidden Cracks. As often the case is in fintech, the user growth didn't lead to revenue growth, and the troubles began in 3 critical areas. A. Digital gold is a capital-intensive business. You're dealing with a real, tangible commodity whose price fluctuates daily. To keep operations smooth, you need liquidity, robust hedging strategies, and tight cost controls. B. Plus Gold's operational expenses were quite high. The operational expenses were high not just for marketing but also for compliance, storage, insurance, and transaction processing. These aren't the kind of costs you can slash overnight without hurting your core offering or value proposition. C. The funding winter that started in early 2023. Investors became more cautious, the valuations dropped, and follow-on rounds became a lot harder to close since early 2023. Plus Gold was already bleeding cash, and the dry spell in funding proved to be fatal. In other words, the gold rush ran out of shine. Co-founder Veer Mishra later admitted, despite strong user traction and early-stage success, sustaining high operating costs without fresh capital became untenable. Part 3. The Downfall. The shutdown of Plus Gold wasn't an isolated case. Gold Pay, another promising fintech startup that focused on digital gold investment, also shut down within a year, around the same time. Check out our 111th episode, where we covered the collapse of Gold Pay. Not surprisingly, the key challenges faced by Plus Gold and Gold Pay are strikingly similar. A. Flawed business model. Plus Gold was chasing growth without clear monetization pathways. B. Cash flow crisis. Plus Gold was suffering from high burn rate and low net revenue. C. Overdependence on investor capital. Plus Gold had no plan for sustainable self-fueled growth. This isn't just a fintech problem, it's a startup-wide cautionary tale. When the hype cycle is high, founders often prioritize scaling user numbers, thinking that revenue will follow. However, in the capital-heavy businesses, you don't get the luxury of monetization at a later date. Plus Gold didn't fail due to the product. It failed because the unit economics didn't work at scale. In essence, a popular idea with a good product can still collapse if the unit economics don't work out. Finally, lessons for the founders. Here are the 5 key takeaways from the shutdown of Plus Gold. 1. Capital-intensive businesses need deep pockets. If your model depends on holding, insuring, and delivering a real commodity, you need not just initial funding, but a pipeline of capital to sustain operations. 2. Early traction isn't proof of profitability. User signups, app downloads, and engagement look great on pitch decks. But investors will eventually ask, how much do you earn per customer? 3. Funding winters remain real and brutal. You can't time the market perfectly, but you can prepare for dry spells by having lower burn, more flexible operations, and at least one path to profitability. 4. Don't rely solely on hype or PR-driven growth. Media buzz is a sugar rush, great for visibility, but not a substitute for solid business foundations. 5. Look beyond the product. Your product can be loved, but your business needs to be viable. Ask yourself, if investor money stopped tomorrow, could we survive? The closing remarks. Plus Gold's journey is the perfect example of how startups are all about execution, economics, and endurance. This is especially true in a sector that's asset-heavy and/or compliance-heavy. Finally, even a shiny product in a market that everyone trusts can still fail if the business model is either flawed or not scalable. Folks, that's it for today. Thanks for tuning in. Please like, comment, and subscribe to the channel. Join us next time as we continue exploring the dynamic world of startups and the valuable lessons from their journeys.